Hey, good evening, everyone. Marty Mazura here. Tuesday, 6th of September 2022, well after the market closed. Normally I would do the midweek update on Wednesday, although tomorrow's calendar I can tell just isn't going to allow me to. So day early, and then I'll, of course, do another one for you at the end of the week. So today we will once again just keep our focus on the S&P 500. I'm going to start with the long-term chart, start with the monthly. We'll take a look there, the weekly, the daily, and then the 60-minute chart. So, folks, not much to talk about here on the monthly. We are still very much in our downtrend here. Recall that we established a target from a technical perspective that put us right around 3,500 or at the 50-month moving average. The conditions there that allow for that target would be either no recession, or now what we're looking at is a relatively mild recession. Something deeper and something that we think would be more protracted will take us down to a lower target. So right now this looks like an area where we think it would make some sense to add some volatility or some risk to the portfolios. We have a longer term thesis that dictates that we allocate to certain sectors that we think make really, really attractive sense going forward that aren't necessarily consistent with how this market has made money for people over the last decade plus. And of course it has to do with the longer term structural inflation theme, where governments are going to be allocating their resources going forward and so on. But again, ultimately we want what we believe to be, call it an all-weather portfolio. So diversification is going to be key, but we are going to be tilting the allocation, as we have already, into areas that you clients really haven't seen much exposure to, oh gosh, since the late 90s, and that would be, the commodity plays and other things that we're in. Long story short, we have really strong conviction when we're looking out 5 years. Of course, all of that subject to change as conditions change. And as I like to say, the next 5 weeks or months are going to be very precarious, I think, and very volatile. And we think perhaps sooner than later we will have an opportunity to consider putting a little more money to work, making some rotations at this level right about here. But again, our analyses are dynamic, and it's day in and day out, a lot of macro work, a lot of technical work, week in, week out as well, in terms of our bigger, longer term indicators that dictate really how we should be allocating and how much risk we should be taking at any given time. The MACD sell signal is, very much in place, continuing very wide gap here. You can see the histogram is showing some acceleration to the downside. Everything is just pointing to what has been one of the best slow-moving long-term signals that actually help also with this price target right here. As for the weekly chart, remember we did a multi-decade analysis here as well, and we identified some patterns that also took us to about that 3,500 mark, and that had to do with the 200-week moving average, which is now up to 573. So to the extent that that analysis and that technical target is the moving average, ultimately actually raises potentially an area where we would engage a little more in terms of taking on some positions here. And we're still talking, 3,900 is about where we are right now. I'm going to talk about these levels down to say 3,500. So it's still a double-digit ways to go, and it's below that 36, 37 mark that a lot of people think is the bottom, and that maybe we'll get a big bounce off of there. And it wouldn't surprise me to get a bounce off of there. But anyway, our assessment right now is that probably isn't all she wrote, so to speak, before this thing's really over and ready to embark on something more positive to the upside. And that ultimately, folks, I know drawdowns are no fun, but we ultimately get to these places and we ultimately do bounce. And the key is identifying, when the risk reward setup makes the most sense to engage more, in a potential for something meaningful to the upside, and then what areas to exploit based on, overall global macro conditions, what parts of the world, and so on, as well as sectors. So on the daily, we we have what we could really probably call a falling wedge here. That ultimately is a bullish pattern for us when we get some bullish divergences on our two momentum indicators, which we don't really have at this point. We also have this trend line right here, and we're right on it, folks. And we're pretty much right on 3,900. So we've been talking more the last few months about options dealers exposure and how they can really influence the market in a really big way. The folks who we've retained to help us understand those dynamics are telling us right now that the market below 4,000, from that perspective, from a dealer positioning and hedging perspective, is kind of precarious. 3,900 is very meaningful support. They call that the put wall. Below that, with some force, could get really ugly to the downside. It looks pretty supportive right here from that perspective, according to them. But a bounce is necessary, right? And then above 4,000, it's a more optimistic looking setup and a more supportive looking setup, again, relative to how options dealers would be positioned based on everything we know right now. Look at the 60 minutes, and then I'll let you go. We do have a bullish falling wedge right there, I would call that. And we do have a somewhat of a bullish divergence here. This, if we got a bounce tomorrow, right now futures are trading a bit lower as I speak, but if we got a bounce and that white line were to recover here, then that's going to be a legitimate, very noticeable bullish divergence here. And then it's already there on the RSI. So folks, over the last months, if not years, as we've drawn these patterns, they are really, really good indicators. But we're in a bear market right now. So if these patterns were ever to fail, it would be in a bear market. Very, very cautious I would be here. If I were a short-term trader, I would probably try to level out my bets and be as neutral as I can and try to do well in either direction if we get a big move up or down. Long-term patient investors, we think both technically and fundamentally, we may have lower lows to go. And it's going to be interesting as the days and weeks unfold going forward, both in the U.S. and, of course, internationally. A lot going on there, as you know. We'll write a lot about that stuff on the morning notes, and I'll also pop in with charts and so forth when I think it's instructive and stuff that I think you'll find interesting. Thank you as always for watching and listening. Talk to you again very soon. Take care. Bye-bye.